Hello, everybody, and welcome to the show today. I'm glad you could join us. So today is a topic we never discussed today, but it's one that I'm really interested in. I was just talking to our guest before we jumped in, and I said this was one of the days when I really had a chance to dive into this topic and know we were going to discuss it today. That makes me really excited to be a podcast host because it's such a really cool topic that I think everybody should know a lot about. So with us today is Paul Birkett. Now, Paul is the founder of Automation Finance, the world's first asset-based investment fund, paying target return of 8%. Now, Automation Finance has more than 200 million assets under management and has saved 1,000 plus families from foreclosure. Obviously, very relevant with what's going on currently in the economy. Now, Paul's audience on social media is greater than 5,000, and he is happy to, and he is continuing to grow his audience by talking to even more people and helping even more people basically save their homes and also earn money as an investor, which we'll talk about as well. Paul has 25 years experience building data-driven businesses in global markets. Prior to launching Automation Finance, he repeatedly built multi-million-dollar businesses for PepsiCo and Procter Gamble in the U.S., Europe, and Asia. Automation Finance buys non-performing residential mortgages at a discount to par and works with the homeowners to return the loan to performance status. Now, they do deliver superior returns to investors, which we're going to talk about that opportunity today, and better borrower outcomes by providing homeowners with alternative to foreclosure. So, Paul, thanks for joining me today.
Ty, thanks for having me on.
Yeah, well, I tripped up a little, but the bottom line is you had a very successful life in corporate credit world and saw a real need, it sounds like. So give me some insight of what made you jump from the corporate space to helping homeowners be able to save their homes like you do now.
Well, way before I started in corporate life, I was a wannabe entrepreneur. So when I was at school, I was the guy who washed cars and mowed lawns. And then at college, I'll give away my age, the era of the mobile phone was just starting. So you could go and get a cell phone that looked like a house brick and carry it around. And I had a couple of stores in Dublin, Ireland, where I'm from originally. So I was a mobile phone retailer for a few years while I was still at college and sold that business, and then got recruited by Procter Gamble to join their management trainee program. And all through Procter Gamble, where I was for almost 5 years, and all through Pepsi, where I was for 18 years, I was thinking, I'm really a frustrated entrepreneur. But as the hair got grayer and grayer, I kind of reached the stark realization that actually I'm not an entrepreneur. I'm a pretend entrepreneur. I talk a good game, but at the end of the day, I don't actually do anything. So I was working through the grind of a corporate life, and I'd made my way up through the ranks. I wasn't a star performer, kind of middle of the pack kind of a guy, but got to VP general manager level, which is not super senior, but still pretty senior. And I got to move to the US in 2010. And so at one point I said, look, either I've got to stop talking about being an entrepreneur and actually do it, or I should shut up talking about it and agree. I'm just a regular guy doing my corporate job, and I wish I coulda, woulda, shoulda, but just get on with it. And so that kind of got me to the point where I said, at some point, I need to make this leap. And the opportunity presented itself in 2014, ultimately, after I'd moved to the US with Pepsi.
Wow, that's interesting. So what got you into making the jump into dealing with non-performing loans? What kind of made you realize this was a problem that you wanted to solve?
Well, I'd come from a career selling soap at Procter & Gamble and selling soda at PepsiCo. So it's an obvious kind of next step, right?
But seems very logical.
But like most people and most businesses, one thing leads to another. I get a lot of people ask me looking for advice. I want to follow my passion, but I'm not sure what my passion is. And that's just the wrong way to think about it. You just do the work in front of you. And from that work, you'll discover what your passion, or where your passion lies. So in my case, I was down in a place not too far from where you are right now in Marco Island in southern Florida. And that was a place that big corporations like Pepsi would take their senior people for strategy sessions once a year. And the meeting finished on a Friday, and as I was standing in the Marriott on Marco Island on the Friday night, everyone else was checking out and heading back to their homes in New York or around the US. I picked up a magazine at the lobby, and on the back page of the magazine, it had local advertising by real estate brokers showing these what looked to be very nice houses, 3-bedroom, 2-bathroom houses. Remember, this is 2010, for 75 or 80 or $90,000. And coming from Europe, you know, houses start at $250,000. So the idea of buying a house for 80 grand in beautiful Florida seemed, I was missing something. But I'm an inquisitive type of guy, so I rented a car and drove up to Cape Coral and Fort Myers and drove around there for Saturday and Sunday. And people who know the real estate business will know that those two towns were really crushed in the real estate bust of 2010-11. And I met with a broker there and looked at some homes, and I just couldn't get my head around it. You could buy a house for 80 grand, spend 5 grand rehabbing it a little, and you could rent it out for 15 or 1600 bucks each month. Seemed crazy to me. You're making 12, 13, 14% yield. So I bought one as an experiment, and it worked out fine. And then fast forward 2 years or so later, I bought 30 houses. And it was great. You know, you had 30 houses, each one renting at about 1,500 bucks a month. So that gives you around, after your costs, about 150 grand a year of income, which is pretty great. I was thinking, hey, hold on a sec. At that time, I was 40 years old. I was thinking, well, I could just retire. Hey, I could have like 150 grand coming in. And I've got my PepsiCo pension and my Procter. So, you know, I'm done. I can be one of those guys, hey, I retired at 40 and, you know, sitting on a yacht. But I think that would be bad for my health for a number of reasons, my mental health and certainly my physical health. I'm a failed triathlete, so I like to ski in summer or ski in winter and try and do triathlons in summer. And it's just depressing watching the times get slower and slower, yet you're working harder and harder. But the reason I got into the loan business was one of these houses I was buying turned out to be a short sale from a big bank, a well-known bank. And I'd forgotten about it because the way a short sale works is you're buying the house from the bank and the bank is taking a loss. They're prepared to sell you the house for a small loss or maybe a big loss compared to what the borrower owes the bank. And it takes them forever, maybe 2 or 3 months for them to work through their internal process. So I'd forgotten about this house. And one day someone calls me from the bank and says, hey, we can't sell you that house anymore. And I'm thinking, oh, well, what house is that? I'd completely forgotten. They said, no, we'll have to send you back your $5,000 earnest money. We've sold the loan. And I thought, that's very odd. What do you mean you sold the loan? Did you sell it to Chase or to some other big bank? I can call them and maybe I can buy it from them. And they said, no, we sold it to a small investor. And I said, what? You sold a mortgage on someone's house to an investor? Because in Europe, where I come from, there's no way you could do that. You've got to be a bank to own a mortgage, period. You don't have a big glass skyscraper, you're not in the mortgage business. And I thought it was really weird because I'd actually been trying to start an insurance business here in the US because the insurance business in the US is strangely much less competitive than it is in Europe. And I thought, wow, I can bring this kind of very aggressive competitive technology to the US and I can save everyone in the US insurance on their insurance costs. Turns out there's a reason why it's basically a monopoly of or oligopoly of 5 big players, and you can't get into that market. But the mortgage business sounded super interesting. So I started researching that, and I met with the guy, and he was just a guy in Philadelphia. He had 2 employees working for him, and they bought lower value, under $100,000 real estate value. They bought these mortgages, and what they were doing was foreclosing, getting the house, rehabbing the house and selling the house and making a profit. And in my case, he had bought the loan for $20,000. The house was worth $70,000, and he ended up selling me the house for $50,000. So and he had paid 14 to buy it. So he was making 4 or 5 times his money. And I thought, wow, even I could figure out a way to make money doing this. So I started going to a few conferences and buying books and researching on the internet. And a few months later, I bought my first non-performing mortgage. So that was how I got into the business.
Oh, that's interesting. So when we talk about a non-performing loan, what is a non-performing loan? Just a mortgage that's not, the payments aren't being paid?
Yeah. So what happened in 2008 was a lot of people lost their jobs. Let's say they either lost their job or there was a divorce or there was some other big life event and money didn't go as far as it went before the big crisis. And so if you're a homeowner, you're sitting there maybe in your home at night, maybe let's just take, let's say a married couple with a couple of kids, and they've got a car outside, and their income has been curtailed by 20 or 30%. So now they say, well, okay, we can't afford to pay all our bills. Well, you've got to pay light and heat, because otherwise there's no light and heat. You've got to pay the car payment, or we wake up in the morning and the car is gone. You've got to put gas in the car. You've got to put groceries on the table. You've got to put food on the table. So you go down that list of all your big expenditures. And for many people, their mortgage is 30 or even more % of their total income. So the one thing that if you don't pay, it makes a big difference to your lifestyle. But also, what happens if you don't pay your mortgage? Well, nothing really. I mean, in the first month, you might get a letter. And in the second month, maybe someone calls you and goes, hey, listen, you need to pay up here. But nothing happens until foreclosure starts. So you've got 6 or 9 months, or in some places, some years, before anything really bad happens. And so the banks are faced with a difficult challenge, because when they make a mortgage loan, they anticipate the borrower is going to pay. They're not really in the business of working with people who don't pay. They don't have the staff for it. The staff that they do have aren't experts in the legal recovery process and what you can do and what you can't. So the bank needs to either send that loan to a lawyer, and the lawyer says, well, I'm in the foreclosure business, so I'm going to foreclose, take the house and sell it, because that's what I know what to do. So the bank can either sell the loan to someone like us, or foreclose, take the person's house and sell it. Now, if you're a well-known bank, the last thing you want on the front page of every newspaper is XYZ Bank makes people homeless and sells their house for a quick profit. That's just not a good headline. So they often choose to sell the loans to someone like us. And we have a big flexibility that the bank doesn't have. And what I mean by that is, if you go to your bank and go, hey, bank manager, I'm real sorry, I lost my job. I can't pay this month or next month or for the next 6 months. Can you just cut me a break? Your bank manager says, well, I can't cut you a break, because if I cut you a break, you're going to tell all your buddies, hey, XYZ Bank, you don't need to pay them. So the next time you're down with your church group, or you're out with your buddies telling them, hey, I've got a great idea for you, then they get contagion through their whole book. No one pays. So the bank sends it to someone like us. No one's ever heard of us. If we give you a break on your payments, the other people whose loans we own, they don't know. They're in the same boat. They're getting a break on their payments too. So it kind of works for everybody. The bank gets rid of a loan that's not paying. The downside for them is that they lose money on that loan. The borrower gets to work with someone like us, where we'll just forgive all the past due payments, because most people, if they've lost their job for 6 or 12 months, they haven't been saving their mortgage payments in some secret bank account. They just don't have the money. So we're not going to be able to collect it. In some cases, you can put it on the end of the loan, or you can find other workarounds, but mostly we just forgive those payments. And then we work with the borrower to get paying again. And after a year, the loan is considered by the market to be a performing loan, as if it was never non-performing. And we can either hold that long term, or we can sell it to an investment fund. And that's really how it works in a nutshell.
So how are you finding these non-performing loans to begin with?
So right now, for example, so we're recording this in the middle of April, in the middle of this coronavirus, which is just horrific. I think that the number of loans that have gone delinquent has gone up to 2 million loans. It took 2 years for us to get to that number in the Great Recession of 2008. So what we've seen in 2 years then, we're seeing now in 2 weeks. So there's going to be a tsunami of loans where borrowers can't pay. Right now in America, there's about 35 million employees who work in leisure industries or transport industries, or all of the industries that are being really crushed by this terrible virus. Those people have no income. Those people cannot make mortgage payments, period. Most of them are hourly paid. It's not like they've got enormous savings put to one side for a rainy day. the banks are going to be overwhelmed with paper. And by paper, I mean non-performing mortgages. They're going to have to sell it. It's just not physically possible for them to modify all of the loans, which is that process I mentioned whereby we forgive the payments. It's called a loan modification. They're not going to be able to do it. It's just there isn't enough people working in all the banks to do all of that work in just the next few months. So the banks will go to a broker, or will go to, in many cases, they already know us because I'm quite well known in the industry now, and say, hey, we have these 100 loans. Can you give us a price on them? And we'll physically buy them. We'll actually take over the ownership of the loan from XYZ Bank. And we'll then be your bank, if you like. And we'll work with the borrower direct to re-perform the loan, to get the loan back to performing status again.
So what steps do you take to really go through and buy those? I mean, they're basically just contacting you, typically bundling them up, and then you go through to do some kind of due diligence and then just buy that bundle?
Yeah, it's almost like you're buying the home, only with an extra layer of due diligence. See, the problem with buying the homes, the reason why I stopped buying houses was because when I got to 25 or 26 houses, I thought my idea was that I'd be able to spend my weekends on my yacht, which I don't have. I'm enjoying my passive income from my houses. Well, there was no passive income. I was spending the weekends dealing with property managers, getting repairs, having places rehabbed. It was all sorts of work, which frankly, I don't like doing. I'd much rather play golf or do something fun than be doing paperwork all weekend. And so the loans business was so much better because we have over 2,000 loans right now. There's no way we could manage 2,000 homes with the same team. It's just so much more complex. So the big difference between buying a mortgage and buying a home is you do a lot more due diligence up front. When you think of buying a home, oh, I like the school district, oh, I like the yard, you know, a few things like that. That's not good enough when you're buying the mortgage. When you're buying the mortgage, you need to know the value of the home, everything about the home, everything about the school district, everything about the taxes, the whole history of the home, all the repairs that have been done, truly every single thing about that home. But you also need to know every single thing about the borrower, because remember, the borrower is not paying. And you want to know what kind of a job they're in, what they're doing, all of that kind of important facts that allows you to make a underwriting decision to say, yes, this is a good borrower. I think this borrower will pay eventually once we've solved their problem. And the home is a good home, because you don't want to make the mistake of buying the mortgage on a home where the home's a wreck, because you now own the loan on a home that is not worth the debt that is secured on that home. So it's a very detailed business. The good news is once you build out your processes and your technology, we can process a lot of loans. To give you an idea, we bid on 600 loans last week. So that's 600 borrowers, 600 houses, 600 payments to go through, 600 everythings. And we did that in 4 days. So just give you an idea that the volume you could do. We hope to buy 10,000 loans between now and the end of the year. So it's going to be a very busy 6 or 7 months.
Well, how do you mitigate risk? I mean, you know, theoretically, the idea here is that you're buying non-performing loans. These people already aren't making their mortgage payments. Love that
Right.
you're working with them to get caught up. And then the
Right.
expectation is that they're going to start paying again. But how do you mitigate the risk that they are going to start paying, especially like in the current climate? Like you said, I mean, we're looking at a tsunami of people not paying, and you're
Right.
sitting on thousands of loans where people could potentially not pay. So how do you mitigate the risk there?
Right. And you've got to assume that no one pays. So you take the approach of, okay, these 600 loans from last week, would I be happy to own these 600 houses? And if I would be happy to own these 600 houses, at what price? So we'll go property by property, borrower by borrower, and say, okay, let's say every one of these individual borrowers says, I am not interested in working with you, go take a hike. And by the way, some people do say that. What would be the price that I'd be happy to own this home at? So we end up buying these loans at about 60 cents on the dollar. So if the house is worth 100,000, we're probably buying that loan for 60,000, because I need to be comfortable that if I have to foreclose and work through that process, I'm probably going to be in it at 65 or maybe even $70,000. and I need to know that I can turn around and sell that house at $80,000 or $90,000 in less than a year from the day I bought it. So I can make a return for the investor, and also we're not taking too much financial risk. So that's really how the numbers work. Where the magic happens is where the borrower says, oh, wow, you'll forgive all those missed payments, because no bank will ever say that to them. If you pull open the newspaper and look up or jump on Google and type in foreclosure, the stories are all around people losing their homes. The stories are not around, this guy helped me out by forgiving my payments. So we're kind of unusual in that regard. And the reason we do it is that it actually makes more sense. Purely financially speaking, you are better off getting a borrower forgiving missed payments and getting them back on track, because this business is an investment. And like any investment, you want cash flow as quickly as possible. So every month that I'm out there with a loan that's not paying, that loan actually costs me money, because I've got legal fees, I've got loan servicing fees, I've got taxes and insurance to pay, all of those things. The minute the borrower starts paying, I've gone from a negative cash flow to a positive cash flow, and that makes a huge difference on your overall returns.
It makes a ton of sense. So I want to kind of talk about this from two angles, because, Paul, with what's going on, you guys are going to be, you're positioned pretty well. As you know, I mean, there's going to be a tremendous amount of foreclosures, and there's also a lot of people that have lost their behinds right now investing into other things. So that being said, how can somebody like me, that's just a typical guy that doesn't know anything about this, not go through all the steps that you took to get here and go through all the training and the courses and everything? Maybe I just want to put my own money into this. Is there a way I could just put my own money into this and then invest and earn a return from what you guys are doing?
Well, there's a couple of ways of doing it. There's some publicly listed mortgage REITs that own mortgages. You could buy their stock. They're crushed at the moment. They're down 80 to 90% from where they were. And those are levered vehicles. So they borrow money from the bank and they go and buy mortgages at about 5 to 6 times leverage. So for every $100 of equity, they've borrowed another $600. And that's why their stock prices got crushed, because there's a risk that some of those REITs will not make it. That's one way. The second way is you could do what I did and go and learn how to do it. It takes a couple of years. It's super interesting. If you like doing puzzles as a kid, if you like doing math as a kid, this is a great business. It's really, really interesting. And you can make good returns. We've made about 17.5% a year since we started. Now, we're an SEC qualified fund, so I need to say that past performance is no guide to the future, but we have made about 17% a year. And we currently have a fund that's open to the public. And essentially what we're doing is we're splitting the return with the investor. So if we could make 17% in a year, we'll pay 8% to the investor. And that's what we've been doing. We've never missed an interest payment. We've never missed a principal payment. And you can go to the website and find out all about that. It makes monthly payments to investors with a target return of 8%, because there are no guarantees. And we actually send that cash out each month to our investors. A lot of IRA investors and a lot of people who have money on the sidelines that they want to keep for either a rainy day or they're waiting for another deal. They'll send that money to us. We'll hold it, use it to buy non-performing loans, convert them to performing loans, and use the borrower payments to pay the 8%. So that's how that works.
Interesting. And I cover it from that side, but I've got to cover it from the other side, because a lot of people listening and watching are having problems right now paying their own home payments, right? It's because a lot of people here are entrepreneurs and the businesses overnight got shut down. So can those people in that circumstance do anything to get help from a company that buys distressed assets like you versus going through the foreclosure process that's inevitable if they don't?
Well, there's a couple of things wrapped up in that question. So the first thing is about 70% of loans in the US are insured and are not insured, are owned by government-sponsored entities, Fannie or Freddie. So you will know from your mortgage statement who owns your loan. Your mortgage servicer will have sent you a letter to explain who that is. So the first step is, if you're struggling to make payments, call your servicer. Depending on who owns your loan, you can get between 3 months and 12 months forbearance. Forbearance simply means that the loan will not be considered delinquent, even though you are not paying. So you can miss 3 months up to 12 months payments without any negative reporting on your credit or any other negative consequences. Here's the thing though that no one talks about. Those are not payments that are forgiven. That is not a payment holiday. Those payments are not going on the back of your loan. If you call your servicer and say, hey, I need 90 days, which is 3 months, in month 4, in day 120, you need to make all 4 payments. And if you don't make those payments, you will be delinquent. Here's what I think is going to happen. I think a lot of people who have called the servicers, remember 2 million people have done it already, and said, I need 90 days or I need a year. They will not realize, because the legal, it's not, I don't believe it's being explained in a way that is crystal clear to people, that even though they're not paying their mortgage, they still need to keep the money and they will need to pay it in 12 months. So I think they will end up spending that money on something else. And all they're doing is postponing a difficult conversation down the line. If you need forbearance and you cannot make the payments, but you think you will be able to make the payment in 2 or 3 months, go ahead. If you're not sure how you're going to be able to cope with what's happening, be very careful about seeking forbearance plans, because you're going to need to write a really big check in 9 months, 3 months, 12 months, whenever it is that the mortgage servicer will give you. So that's step 1. If you can do that, you should do that. If you can't make your payments, then you need to start thinking about how you're going to get out from under. Maybe you've got too much home, as people say. The house is too big, your payments are too big. You have a bigger house than you need. Maybe you need to sell it. I think prices today will be the highest we've seen for quite a while. I expect house prices to start to fall, excuse me, in the next weeks and months. And I think we could see a year or 2 of a very, very soft real estate market, simply because there will be many forced sellers. And forced sellers means lower prices, irrespective of what interest rates are. Interest rates are at an almost all-time low, but that will not save all of the people.
That's interesting. I mean, it's really interesting because a lot of people, I think, are going to be in that situation that you're describing. So a lot of people that probably try to get into what you're doing make a ton of mistakes. What are some of the biggest mistakes that you see people make that are trying to get in at the ground floor and do what you're doing without working through somebody like you that already has an established process, fund, et cetera?
Well, speaking from painful experience, the way I figured out how to do this business, people say it's trial and error. I made all of the errors. So I found every way to lose money in this business, sometimes twice.
Spoken like a real entrepreneur.
Yeah, it's a lot of moving parts. And sometimes you're dealing with people who just fell on hard times. But in some cases, you're dealing with people who are what's often called strategic defaulters. They have no intention of paying. There may be scammers. They're trying to get something for nothing. And you need to have a spidey sense for those people and make sure that your legal processes are robust and that you don't get either hoodwinked by someone who has no intention of paying or tricked into doing something that is not compliant. And then they sue you and you have to settle with them. And all of those things have happened over the years. The way I got started, I bought 1 loan and it worked out super well. And then I bought 10 loans and it worked out super well. And I thought, hey, I'm a genius. Finally, the universe appreciates me for my gifts and I can now, move forward to be the billionaire, just like Mark Cuban, that I deserve to be. But of course, that was a big mistake because I then bought 1,000 loans and that was a disaster because 1,000 loans is much more than 10 times harder than 100 loans. So were just destroyed. There was way too much paper. We just couldn't cope with the number of borrower phone calls. It was crazy. So we opened the tap way too big and the spigot just pumped out all these loans on top of us. So there's a lot of mistakes that you can make and they start with A and they end with Z. This is not a business that requires huge intellectual capacity. It requires extreme detail and focus. And you need to know quite a lot about accounting, quite a lot about the legal process, quite a lot about how each county works. There are 3,000 counties in the US, and guess what? There's no federal county system. So every one of them has a different system, and what's allowed in one county is forbidden in the county next door. So it's just a process of learning over time. It's very hard to say, here's how you do it, There is no one way to do it. There are 3,000 different ways to do it.
I'm curious, do you know anything about the borrower or the buyer, that owns the home before you actually purchase? Like, do you look at them as an individual level? And if so, like, what information do you know, or what should you know?
I know everything about them that the original bank that made the loan to them knows. So I know where they work. I know roughly what they make. I know what their credit looks like. I know who they're paying, who they're not paying. I know, are their taxes paid? Is their home insured? Have they liens against the property? Are there unpaid home renovation costs? You're always looking for the reason why they stopped paying. And it's usually maybe the borrower is dead. Sometimes that happens. You get deceased borrowers. Sometimes it's a divorce. Sometimes it's a sickness. And sometimes it's a other life event, something like that's a one-off thing that you just hope never happens to you. And once you understand the why, you can then start crafting a plan to help that person get back on their feet. If you don't know why they've stopped paying, then it's hard to help them. And sometimes, like we've a case just today, the borrower has moved out of the US. They're not in the United States. We can't find them. We can't contact them. They just abandoned the home. So we sent a realtor to take a look to find out what was going on. And there's a lockbox on the meter in the side yard for the either electric or gas. And the code is written on the lockbox. And the realtor went inside and found a note on the table saying, we've been trying to work with the bank since 2008. I don't know when they left the house. They left it in the last 10 years. And we failed, so we're just leaving. So I guess I know where they're from. So I suspect I know where they are, but they've given us back the keys and abandoned the house over years ago. The letter was undated many years ago.
So do you look at this before you buy? Like, if you're buying a bundle of 100 loans, are you going through this after you own the 100 to try to get them back to a state? No. So you vet everyone before you buy.
Yeah, I've got a bridge I want to sell you.
Okay, I get it. So you just said there are such things as dumb questions.
Well, the thing is, there's from time to time, I get a call from a new investor who wants to buy loans, and they've somehow found me and they called me up and say, hey, I want to buy a loan. And they're ready to send me money. And they haven't asked any of the questions. It'd be like calling someone up and saying, hey, I want to buy your car. Can I send you a check? Well, don't you want to know what type of car it is? And if it has an engine, and if the engine turns over, and no. So there's ample opportunities to lose all of your money. So it's not something for the uninitiated to go into unless you're going to do it a 2 or 3 year project and like really learn how to do it slowly but surely.
It's interesting because, the big banks, I think that's what they do, right? I mean, that's how the mortgage crisis, for the most part, really unfolded in 2008. They were just buying these bundles of loans that were really subprime when they believed a lot of them were prime. Right. A lot of that was contributing, as you know. So that's interesting. Okay, so as we get ready to wrap up, Paul, I mean, what should everybody do if they want more information on either side of this? Investing potentially with you, which you have the experience, you do this all the time. So maybe I want to put my money in and get an 8% return. Let me know, and then maybe on the other side, I mean, what can people do if they need some kind of help right now? Can you offer them help or guide them to somewhere there? Can you talk about both of those?
Yeah, there's lots of things. So the investment piece is super straightforward. Go to automationfinance.com and just click on the button. Watch the videos, read the circular. You must read that circular because it's very important that you understand the detail of how the business works. We just discussed it very briefly here, but there's a very detailed write-up that we did for the SEC before we got qualified. So that's pretty easy to do that. The returns, we're paying an 8% return. That's the target, and hopefully we can continue to do that. I think the market is going to be kind to us. We're going to help a lot of people, but we'll also make good returns in the future. If your listeners and viewers are struggling with their mortgage, first step, call your loan servicer. It will be on your mortgage statement each month. If your mortgage servicer is not helping you, there is a list of HUD-approved housing counselors. Just type into Google HUD-approved housing counselor and your zip code, and you'll be able to speak to somebody. And they will work with you. They're usually pro bono. You don't need to pay them. And they will act almost like your advocate with your servicer. So they'll negotiate with the servicer to try and help you and get you to keep your home. People with 401ks, people with Roth IRAs, if you can demonstrate that you are in distress, in other words, you can't make your mortgage payment, they will allow you to make a penalty-free withdrawal each month to pay your mortgage. So that might also be a way that you can stave off the inevitability. If you don't think you're going to be able to keep your home, you know, for a lot of people, they've known for a while that they really have more house than they can afford and they should think about moving. I would suggest they move sooner rather than later, because I think real estate prices in the next year, maybe 2 years, are likely to go down rather than up. Maybe they won't crash, but they'll certainly go down. So you want to get out and preserve as much equity that you've built up over the years that you possibly can.
Paul, thanks for coming on today.
Absolute pleasure. Great. Love your work, Ty. Thanks for having me on.
Yeah, thanks for being here. And everybody, wow, right? I love finding just really interesting new ways to be able to get a good rate of return on your investment, especially something that's kind of, I'm not saying it's recession proof, and Paul wouldn't claim that either, but it is something that when things get bad, like COVID-19 or even in 2008-9 crisis, it creates opportunity in certain areas. We've seen this. Every time the economy changes, there are certain industries, there are certain sectors, there are certain businesses that it opens up huge opportunities for. And this is one of those opportunities where there's a huge opportunity to be able to jump into this distressed property kind of area where you can get consistent and good returns on your money, even at the same time helping people that need help. And that's what I just love about this. I think it's cool because you can get really good returns that way are higher than anything you're going to get in the stock market. But the other thing is think about it. You're really genuinely investing in helping people. You know, the whole idea here, the whole model is to understand what their hardship is and then help them when they desperately need help the most and give them a chance to stay in their home. And from what I've seen, when you do that kind of goodwill and genuinely want to care and help for people, the returns are abundant. So if you want to learn more, go to automationfinance.com, automationfinance.com. There's all kinds of information you can get, especially how you can actually get started in investing with Paula's company, with investing in non-performing loans, help people that desperately need your help while earning a really good return at the same time. So make sure you visit automationfinance.com.